So to be the lowest since COVID is incredible. You know, if we're all talking about it on our trading floor and we're writing reports on it, and you know everyone's talking about it on LinkedIn and whatever, like I'm pretty sure it went viral within the trading community and in the oil markets, and then it just was a good reason to buy. And if you couple that with the kind of the emotional response from Saudis, and then you couple that with SPR buying, it was a pretty perfect storm in such a short period of time to kind of take us back into the 80s, and now it's like nothing changed. Hi again, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, joined today with Mita, Vincent and James. So post-OPEC meeting, the market scrambled to the exit and in poured doom and gloom that looked to be gathering momentum. But within the space of a couple of days, we are right back to where we were, and the glimmer of hope for summer strength has become more of a gleam and maybe even a sparkle as forecasters double down on anticipating demand increases that they hope will lift oil markets out of this persistent overhang. Such is the flaw of human recency bias. It turns out we had something very similar last year, only for the market to indeed perform for summer contracts. So, did we speak too soon last week? Let's dive straight into it. Vincent, go on.
So yes, crude flat prices right back to where we were pre the OPEC meeting, as the August contract fell to lows of $77 before climbing all the way back up to $82 this morning. So it does seem that the market was quite saturated on the sell side during the peak of the sell-off, as the official CFTC data indicates that net positioning in Brent from money managers was at the lowest level in over a decade. So it was very, the shorts were quite vulnerable during that time, and unsurprisingly, crude prices bounced back up going into the end of last week. You had a few headlines. For example, the US Department of Energy was announcing tenders to buy oil for the Strategic Petroleum Reserve, the SPR, whilst there were some headlines coming from the Saudis as they tried to calm the markets, stating that they do also have the option to be flexible and to not bring barrels if the situation calls for it. So that means that the return of barrels to the market in Q4 is actually not guaranteed. Interesting enough, OPEC released a video on Twitter last Wednesday showing highlights of a briefing held by the energy minister with various journalists post-decision. Also, the energy minister criticized Goldman Sachs' bearish narrative on the oil market, that the bank used numbers that were wrong. As well, also the energy minister and the OPEC Secretary General made similar comments at the St. Petersburg International Forum last week, which made rounds with the news outlets.
Yeah, so I think we talked about this last week a bit. You know, OPEC, particularly the Saudis, they very much believe in market sentiment as much, if not more, than fundamentals, and being quite vocal about that. So I think when they feel they're losing control, that's when they really start to talk out, and it always looks like they're panicking, right? The whole like, I'm going to make sure that the shorts are ouching. Yeah, that's a famous one. But this time round, it was attacking Goldman Sachs. I mean, it's just like it clearly does work, because it's like an emotional response, and then you think, well, like, you know, when they get emotional, like they're capable of doing quite dramatic things. So I think that must have been, relatively convincing, just kind of signaling, you know, we're in control here, and we'll do what we need to do. That, I guess, that was helpful, but for sure, this is what's been on all of the traders' chats in the last few days, is the positioning, right? I mean, all of a sudden, so this is the problem. It comes out on Friday at 8 p.m. and really you're only digesting it Monday morning, which is, you know, only yesterday. So I think it's quite likely that there's a lot of systematic trading signals based off positioning, especially when it comes to extremes like this. So to be the lowest since COVID is incredible, right, on the short side, and the longs are very not long as well. So that in itself, I think, was like if it had been left and not highlighted, would it have been as much of an impact? I don't really believe so. I think, as I say, people are trading off these signals. It was, if we're all talking about it on our trading floor and we're writing reports on it, and everyone's talking about it on LinkedIn and whatever, like I'm pretty sure it went viral within the trading community and in the oil markets, and then it just was a good reason to buy. And if you couple that with the kind of the emotional response from Saudis, and then you couple that with SPR buying, it was a pretty perfect storm in such a short period of time to kind of take us back into the 80s, and now it's like nothing changed, which is quite significant, because we were quite aggressively talking about all the underlying bearish things and accepting that, trying to accept that this wasn't going to happen, the summer strength wasn't going to happen as we kind of anticipated, but lo and behold, we're right back to where we were. So it's getting very interesting, and I think the short squeeze on the futures market, so the Brent Futures is one thing, but the time spreads was very aggressive as well. We were approaching contango in the prompt spread right up to like mid 40s now, and 50 kind of cents levels in the more deferred. That's a very strong indication of backwardation. That's strong physical diffs that the market is implying there, which is going from super bearish to like quite constructive overnight, which is really quite difficult to trade, I would say, first thing. But second of all, it's actually quite hard to commentate on as well. So I don't know, we're gonna have to kind of keep digging into these things. So I guess I'd like to talk about China, because that's kind of rearing its head again. But before we get to the macro stuff, I think it's better, let's talk about the underlying market a bit as well. So Mita, do you want to just start with refinery margins?
Yes. So M1 refinery margins in Europe continued to weaken this week by nearly 35 cents, but the same in Asia climbed by around 50-60 cents this week. So Asian margins also appear to be picking up compared to how low they were at the end of May. And I think a lot of this has to do with how middle distillates in Asia are performing. But before we get to that, let's first talk about gasoline. The market still looks less confident about gasoline. For the week to June 4th, CFTC data showed that RBOB net positioning was down by 4.8 million, with total positioning at 33.2, which is the lowest since October last year. EBOB cracks in July looked range bound around 16 to 17. They're still seeing
net long positioning, or
that's net. Yes, so net long positioning, so long minus short. But yeah, so that was down by nearly 5 million, and it's the lowest since levels seen last year in October. EBOB cracks are still seeing resistance around $17. The Sing 92 climbed into this month. It hit $8 per barrel on June 5th, but has since also sort of petered off in strength. So that's gasoline, where very little is happening. Everyone's still really risk off. There's limited strength to be seen, and which is odd, because just with summer demand and how everything we were anticipating. In middle distillates, so gas oil cracks in Europe continue to weaken until a week ago, with CFTC data also showing that weakness, but these have since seen more strength. The July swap crack was at 17.90 on June 4th and is currently at 18.60. Asian gas oil has been more muted, so the East-West sharply rallied until around June 6th, and has since we now see more resistance, with, I'm not entirely sure why, but I think levels were just toppy because of freight being offered, and now they're just seeing resistance at these levels. But the real summer demand right now looks like it's appearing in jet fuel in Asia. So Kero spreads have been rallying. The July-August Kero spread rallied from -20 yesterday to flat by close of yesterday, and it's currently in positive levels. It's currently at 8 cents per barrel. Regrade's been roofing. It was at negative 1.40 a week ago, and it's at negative 60 cents right now. And a lot of that has to do with combo buying, fizz buying, and just really strong aviation demand in Asia compared to Europe. The same in Europe has been really weak, also with news on the Dangote Refinery sending in jet as well as gasoline into Europe. And I think that, alongside just pre-existing scheduled arrivals of jet into Europe, sort of just brought more bearish sentiment into the continent regarding a supply overhang, despite anticipated summer demand.
Yeah, there's a few things to unpack. I mean, ultimately, gas oil starting to perform finally is is a big deal. It's a biggest part of the barrel on the product side. So it's indicating some resurgence in, well, I guess sentiment, but also possibly macroeconomic support. That's what you'd expect with diesel. Jet fuel is also a distillate, and I think that just want to highlight, staying with what we've been saying over the weeks. We talked a lot about Singapore Airlines situation and flying and lagged data as well. What is the impact of these events? And we mentioned that airline consumption could go down because people are worried about these things matter, but clearly, I mean, now that we have the data, that's probably from that period, or maybe it hasn't quite come through yet, but either way, it looks like there's data that's coming through now that is lagged, but it's showing that no, the summer demand, summer traveling is really picking up, and it's coming through into the oil prices. So just context for some of the numbers you were throwing out there, a time spread, July, August, kerosene or jet fuel in Asia going from minus 20 cents to plus 8. It's significant because, you're incentivized to store it to next month, to now you're incentivized to sell it in the open prompt market, which indicates prompt strength. So that is a huge shift. And I think the regrade, jet fuel versus distillate, that coming good. That's all like quite structural indications, along with gas oil, that the distillate part of the barrel, which is the economic kind of correlated market, is starting to really perform. So that bodes well for a generic bullish view on oil markets, actually. As I said, all flipping on a dime. So that's interesting. The other thing was, as you were talking, I was thinking, this is again how you'd have to look at all things in isolation in oil markets to gauge the psychology and the sentiment and positioning, because the big market position being long distillate cracks, but majority actually was long gasoline. And so the gasoline market kind of being the predicted savior of the market, or the driver of price increases this year. And the way to put that position on is buying RBOB versus Brent, buying EBOB versus Brent, and actually buying gasoline versus naphtha is a big trade that the professional oil traders like to put on. It's performed the last few years very well, and it tends to outperform naphtha so much that it's quite a clean, nice, smooth way to capture bullish markets and bullish gasoline. So when you have that net long position, yes, the cracks were coming under pressure, and that was causing stop outs and the rest of it. But what was under kind of weighted in the stories that were going around about market positioning psychology was the gasoline versus naphtha. So some of the hedge funds that have stopped out and pulled out of the market, they were allegedly long these things. I think a lot of market pain has been felt from being long gasoline versus naphtha, and it's a small market naphtha, but this is what I'm saying. So you have majors, it looks like, very long naphtha into June, kind of throughout May into June, and did very well. It looks like from our data that they were kind of long naphtha cracks around 10, 9, all the way up to -7, starting to take profit, but they're aggressively taking profit. And what that did was, this $3 to $4 crack rally, per barrel rally in naphtha cracks, is squeezed that gasoline versus naphtha differential, right? Naphtha strengthening and gasoline not being so strong compressed that differential, which is like a massive pain. And then you have people stopping out on that differential. So then you've got a lot of people actually losing their jobs, not losing money on that, which then factors into having to stop out into the cracks, having to stop out of Brent, having to, so that basically the domino impact of a small market like naphtha can have a shockwave over the entire psychology and general sentiment in the market, is what I'm getting at. So now that that's over, that's reversing. Majors having taken profit, and again, this is all in our data. We've now got naphtha on the sell side coming way back down to 10 again. Trade houses getting short, physical looking weak, gas snap performing now. Gasoline cracks starting to look okay. I know you said there's resistance at 17 on EBOB, but there's also kind of a floor at 16. So that combined with gas oil and combined with the time spreads in Brent suddenly going mid-50s, it's amazing. We're suddenly back to a really structurally constructive market. So you had Jorge doing his the world's going to end doom gloom last week and we're all bearish, but you just can't say that anymore. It's flipped on a sixpence. Really, really interesting stuff. So that's a good time, given all that, James. These are very on the gas oil and gasoline side, as I say. This is macroeconomics really performing. So Is that backed up with what we're seeing on the...
Yeah, one thing I did read over the weekend actually is that flying in China is coming in much higher than expectations over the last month. Much more people are travelling, which would have a straight impact on particularly the jet fuel kerosene that you're talking about in Asia.
Well, this is it, because, you know, again, always going back to this lagged data concept, supply and demand data, supply and demand models can only be verified based on lagged data, and then you have to predict forward. And it's very hard to get it accurately done. So now people are starting to say, oh, China looks weak in the fundamental data because it was lagged from the first half of the year. Well, we already knew we were seeing the indications of China being weak. It's since come out of that in terms of stimulus, in terms of, I guess, demand. And we've seen the buying and deferred contracts from China. So I would predict that, as you say, with the airline data now being quite strong for China, we're going to see a bit more of that going on, and that actually looks quite constructive. Is that?
Yep. And one other thing we've seen with China is the two PMI data readings that come out of China for manufacturing. One is official data, and the second one's the Caixin data. The Caixin came in last week much higher than expected. It jumped to, I think, 54 point something.
Sorry, this is what data?
This is a manufacturing PMI data in China. Right. There's two. The official one came in just above expectations, but the Caixin, a separately recorded data, jumped much higher. So it's early signs. It's not conclusive, but there are signs of development, growth, green shoots of recovery, you might say, in the Chinese economy.
And what about the US?
The US, we had interesting data last week. During the week, the jobs data that came out, JOLTS, continuing claims, jobless claims, ADP, all look weaker. And we went to Friday's big payroll number, and the headline surprisingly jumped much higher than expected. So when you drill into it, so it came in at plus 272,000 jobs, expected 175. The algorithms react to this in an instant. So bond yields surged. I think the 2 years closed today something like 16 basis points higher. The market saying the economy is much stronger. The Fed will only need to, the banks have put off their first cuts from, some were looking at July, they put it off to September, December. But when you drill into the data, underneath the headline, it actually looks a bit weaker. The unemployment rate rose to 4%. That wasn't expected. And the key point, again, it's all part-time workers, up 286,000, while over 600,000 full-time jobs were lost. But the market reacts to the headline, so yields went higher. The dollar went higher as well. And a reaction we saw then was precious metals started to get hit. It came out exactly the same time as the headline that the Chinese central bank, the PBOC, have ceased buying gold. So you had that headline, dollar strength, and then gold suddenly fell 3.5% on the day, silver down 6.8%. Other commodities fell, copper was down 4.1%.
So, and you've been quite consistent on the US side that, some rosy data, some interesting things on the upside, but the unemployment rate is
starting to tick up. Yep. So manufacturing continues. It's been something like 18 months where it's been in contraction. But the service sector's 3 times bigger, and that's still in expansion.
So how do you marry the two then? What are you thinking now?
I think the key is unemployment rates ticking up. That's a trend. That always starts a trend. You've had UK unemployment suddenly jump this morning, and the unemployment rates jumped to 4.4%. It's becoming a global phenomenon. Unemployment rate starts to tick up. So the economies are slowing. The central banks will have to act.
Again, this is lag data.
Yes.
Is it what could be driving the unemployment rate that potentially might have been solved in the last couple of months? Well, what are you thinking? Why is the unemployment going up?
Basically, demand's falling. People are not spending as much. We've seen retail sales has been falling, not just the headline, but when it's inflation adjusted, it's been the volumes have been falling aggressively. Incomes, lower income households are really hurting. So I think people are spending less, so companies are starting to retrench. And actually the key point this week, we have CPI on Wednesday, but we have the Fed meeting Wednesday night. Now they're not going to move rates, but it's what Chairman Powell, the market will watch what he says, and he will give his interpretation of the jobs data.
And you don't think there's anything just seasonal about this?
No.
So it's genuinely
if you look at the unemployment rate, it trends unfortunately really well. When it starts to go up, it typically continues higher until the Fed have
really
a long way into an easing cycle.
So it's kind of like a deferred squeeze from cost of living crisis, you think, is starting to eat into jobs?
Yes, but at 4%, having said that, it's not a a problem for the economy. It's slowing, but it's been going gangbusters. We've had inflation at huge levels. So the economy's slowing, bringing inflation down, but it's...
Does the market need time to have a period of low inflation then?
Inflation's coming down. It's got to a level it's stickier now. It's expected to come out at 3.4% CPI. But we're starting to see rents should start to come lower again. The CPI data uses a survey for rents, which is fairly absurd when you can get actual data from Zillow, an apartment list on from the internet. So rent should fall, inflation should continue to grind lower, but it's taking time to get to the central bank's targets.
Again, I'm just trying to understand this. So if you have a cost of living squeeze and things are getting more expensive, surely you would work. You're more likely to work.
If there's jobs out there. And people are being forced to take, we have now, it's just off record number of people taking second and third, having to work multiple jobs.
Hence the part-time work
Hence part-time job is continues to go up, which to me is not a sign of a strong economy.
So full-time workers being laid off, essentially, is more like, rather than people not wanting to work or retiring or whatever.
Absolutely.
It couldn't be possible, like aging population, some of that.
We had that during COVID. People decided to retire and not come back to work, but now it's a case of people are being, full-time jobs are being lost and people are being forced to take multiple jobs, part-time jobs.
Definitely something to keep an eye on, essentially.
But again, we're a long way from recession. 4% is not.
What is the figure we tend to get worried about?
I think if it heads towards 4.5%, then the Fed will certainly start to get nervous.
Okay.
And again, it will be interesting to see Fed Powell's commentary on Wednesday, because he'll address exactly this.
And the significance of the precious metals. I mean, it's been a big story. You know, the inflation hedging it started with, and then just hedging against wars and things like that. And then China, national banks, Russian even bought it during, I think, pre the war, things like that. So do you think it's just a case of end of the buying flows, like the buying mania, or? I
think short term, you'll get a pullback. If you were in that position, it's a great way of getting a pullback before you start buying more.
Because, you know, what I'm reading anecdotally, like copper, for example, that's still a big one for people. Like there's still a lot of interest in taking that market on, because the fundamental story still makes sense that we need copper for the transition and all that. So it's chosen their moment now to kind of put the squeeze on, I guess. But why would copper be so correlated to the rest of it? Just, I guess, a macro risk off.
Yes, exactly.
Yeah.
And positioning as well. What I find interesting, though, we talk about oil and the bearish positioning now, but at the same time, commodities, you have such bullish positioning on other products.
But that has been a theme. We noticed that oil was lagging the rise in precious metals, and now it's reversed. So it's like they're decorrelated, basically. So is it potentially likely that risk parity has been trading like that? You know, long precious metals, short oil, or not short, but low weighted oil?
Probably, yes, because it's been
it's a renewable narrative, right? And things like that. And it actually
and also just trend following. And I think it becomes, you know, the social media, we've talked about it before, people chasing, whether it's GameStop or whatever. All of a sudden, it's the headlines were copper, silver, gold.
So underweight things that aren't exciting and heavyweight on things that are. Simple as that.
Yeah. And if you know central banks are buying.
No, of course. Yeah. Of course.
And one other point, actually, you talk about lag data with CPI. Of course, CPI this week, but of course, with oil price coming down, that will filter into CPI in the weeks and months ahead.
Yeah, no, exactly. As we're yet to see it in the data with the kind of lower prices we've had in the last month, even though they're ticking back up again, that should, I agree, that should be supported. An
important point on that, oil has a far bigger impact on CPI. The likes of copper going up, that has a bigger impact on PPI, but PPI has been very low. So we'd expect the commodity move would have more of an impact on reducing CPI.
Cool. Okay, so what is the Google saying, Vincent?
I have a few headlines this week. So about global jet fuel. So global jet fuel demand soars, boosting oil prices. That's been a key story narrative, as Mita discussed earlier. So jet fuel demand is rebounding across regions, surpassing pre-COVID levels as people have shaken off the pandemic years, traveling en masse again. Kerosene demand, jet fuel demand is driving global oil demand growth this year. In fact, the recovery has generally been led by the short-haul sector. For example, flights across Europe or domestically in China. You have the summer holiday travel, but also in China you have the pent-up demand as well. Still, a lot of people are recovering on since the COVID times, and especially during the times of Chinese public holidays. That's when demand is especially crazy. Anecdotally, you would see on, I would see on WeChat, all my Chinese friends all posting pictures of them traveling to different destinations around the country during the public holiday time. It seems that that's the time where everyone seems to be
you were mentioning that during the new year, right?
During the new year. So recently, this week, yesterday was a Chinese public holiday, the Dragon Boat Festival. So that's a 3-day long weekend, and that's all when
there's a
people
lot of traveling during that time.
Yeah, during all the holidays, and there'll be some coming up as well. According to Bloomberg, international flights from Asia should climb by around 23%. Singapore passenger numbers at Changi Airport up in the first quarter, exceeding 2019 levels, but it's also a result of the visa-free policy between China and Singapore that just started this year. So a lot of back and forth traveling between people of those countries. But another one, however, the outright jet fuel demand may be suppressed by increased efficiency. For example, perhaps airlines wanting to become more energy efficient, which is holding back consumption, but also like fitting people more people onto airplanes. So you might have more people traveling, more ticket sales, but if you're squeezing more people onto an airplane, like what Ryanair does, then that would
so we might see the standing seats after all.
Maybe, right?
Cool. Anything else?
So Iraq oil minister reports progress in talks with Kurdish officials on northern exports. So there's been progress in talks with Kurdistan region officials for a deal to resume oil exports via pipeline to the Turkish port of Ceyhan. So that pipeline once handled 0.5% of global oil supplies, but since last year it's been stuck in limbo due to legal and financial hurdles. So if flows resume, then that could be a bearish factor for CPC crude, which is traded as a differential against dated Brents.
Yeah, no, fair point. Okay, no, that's interesting. And
one more, that's I guess that's my time to shine. New Zealand to lift oil drilling ban amid blackout fears and blow to Starmer. So this headline came from the Telegraph, of course. UK journalists want to relate that to the UK elections, where, of course, Keir Starmer's Labour may also plan to impose a similar crackdown on North Sea, perhaps no new drilling or oil and gas exploration there. But New Zealand this weekend is expected to revoke a previous ban on drilling for oil and gas from the perspective of energy security. So this ban had been in place since 2018 from the previous government. Recall that last year the country elected a new centre-right coalition government. So they have been in talks wanting to invite energy companies to resume exploration in New Zealand's 3 major offshore fields that supply most of its gas. So that would be an offshore near Taranaki, which is on the west side of New Zealand's North Island. And so it is very much an energy-rich region in the west of North Island. So of course it's good for gas supply, but the goal is also to create jobs, which is important in the New Zealand context because there's a lot of inequality between the major cities and the regional areas. So by bringing in investment, that would add more local jobs, which would improve the local economy. But it's also interesting because since COVID, New Zealand had shut down its only oil refinery in the country, the Marsden Point in the north. That was a 96,000.
Didn't you visit that last time you went?
I did, yes. Yeah. There might be a video coming out in the future as well. That was a 96,000 barrel per day refinery with a hydrocracking unit, and it was responsible for importing half of New Zealand's refined fuel products. So the thing is, although that might improve
exporting, you mean, or reliance on import? Okay, yeah,
importing. If there's more oil and gas drilling in New Zealand, it would help with the gas security, but not necessarily oil, because that would be exported to Australia and Singapore anyways. So it's more from a gas perspective.
I think it's worth touching on the politics here, given all the elections in the second half of the year, it's quite important because, as you said, Labour government are going to be very clear about their cracking down on North Sea, and then New Zealand is another example. But I'm sure there's plenty where you have the different political viewpoints leading to different structural situations with oil and gas. So what had happened before? There was a bit of a crackdown on that's why the refinery was closed and the exploration was banned, right?
Yeah.
Okay, so and then I guess that was just reversed, different political thinking, and it's just simply that,
something like that.
Yeah. Okay. So I mean, UK is going to have the same thing, but again, UK, not a huge consumer on the like compared to the rest of the world, obviously. So yeah, but then again, you got Biden versus Trump, so it's all gonna. I think it is significant. I'm not sure exactly how we play it from the price side because all these localized things. They're not likely to cause like an overall like structural shift in the world, but they will impact the differentials between the regions, which are increasingly important, and then shipping prices and routes and things like that. So, every time you shut down, what's clear from 2022 is that, and the same thing with New Zealand, you shut down your ability to provide fuel for yourself, then you need to import it. So you're really gambling that you'll be able to replace those imports with, renewable consumption essentially. And if not, you have energy security fears. As you say, you mentioned the 1979 global oil shock. That was the reason for adding the hydrocracker in New Zealand, you're saying. But, we just had it in the UK and Europe. We had to basically build a bunch of LNG terminals at record pace. And we're still importing, most of our oil and gas. So I don't know. It looks like, on balance, we could be doing more of that, right? So I guess that's kind of bullish shipping prices. That's bullish, like the kind of import situation. And I guess you can expect, it's great for oil traders and gas traders because you're basically just spotting imbalances around the world, and that's how they make their money. So that's likely just to continue, basically. But I thought it was worth noting on that. Okay, so what is the trade idea for this week?
So it's more of a view, but we continue to hold a long position view on US propane. Yesterday's European window saw ARBs, that is saw flat price be very well bid, that is just flat LST price be very well bid. We saw ARBs, that is the difference between US LST and Asian FEI, as the aggressive buying from importers and offers were lifted in the physical window as well. The July LST FEI moved from negative 245 a week ago to negative 220 now. And LST spreads have been seeing real buying with from trade houses up to negative 0.50 cents per gallon. Flow-wise, we now see a balanced 50-50 7-day split in the July LST compared with a more short position taken in the week to June 6th and an even more 40-60 long short position taken in the week to June 3rd. So we see the market getting longer into the week, and I just comparing that with what we see, just marrying that with what we see in the physical window alongside the fundamentals, that is reduced US propane production that could continue into June. This week's EIA stats are also projected to display a build of 1.742 million barrels, which, should it come to fruition, would be the smallest weekly increase since the end of April, which should be bullish in the near term. Of course, if EIA stats do conversely happen to be more bearish, that would immediately be more bearish LST. But for now, given just how flow has been going, given our own data showing the increase in length into the week, and with everything that's being expected for US propane production, we continue to hold a long position view on it.
Okay, fair enough. And I guess this is a nod to, we have all this data that's backing up what you're saying, but I guess to find that out, we'd like you to come in and look at our data, basically, is what you're saying. So rather than a trade idea. Okay, fair enough. So our poll last week, we were saying what's the best risk reward trade right now for the OPEC bearishness, which now doesn't look so bearish, but ultimately we're thinking from a structural point of view. Is it long Brent Dubai, whereby relative Dubai weakness finally would send the differential skyrocketing, given how much Dubai has been holding up the overall crude complex for so long, or is it short WTI Brent? Because ultimately, in bearish markets, crude markets, US has to export its crude to get rid of its glut, and if people don't want the crude, then the glut builds, and WTI is a landlocked crude, so I like that one personally. And then just long the puts, out the money puts on Brent. But yeah, pretty balanced, because I guess they're all three are kind of bearish trades. But yeah, maybe now things are very different. Be very curious to hear people's opinions on that on LinkedIn. So we should kind of probably put that in the next poll as well. Okay, well, thanks everyone, and thanks everyone for tuning in. Just a quick reminder: Jorge Montepeke has released his The Officials, which is the first derivatives fair value assessment in the market. That's available on onyxhub.co. He's also publishing on LinkedIn every day. I think that should be very, very useful for people out there, so please do check it out. And again, thanks for listening, and see you again soon.